right. Record the following transactions for the month of January for the Bwezani family, balance of all the accounts, and then extract trial balance as at 31st January 2023. All right, so we've got a list of transactions. We're going to need to do some journal entries and open accounts, okay, or ledgers. Okay. So as we go through each transaction, we'll do the journal entry, we'll open the account. Yes. So the first transaction started a business with 205,000 cash. Oh, I forgot. Whenever you are dealing with journal entries, all right, always remember you have to identify the financial transaction that is going on. After you're able to identify the financial transaction, then you have to know which two accounts are involved. After you've determined which two accounts are involved, you're going to determine which account is increasing and which account is decreasing. Sometimes both accounts can increase, sometimes other accounts can increase. So at that point, that's where we'll apply the double entry rules, which are here. All right. So we begin. Started a business with 205,000 cash. So, colleagues, what transaction is going on here? Capital injection into the business. Wonderful. What two accounts are involved? Mhm. Yes, there'll be the cash account and there's going to be the capital account. Yes. So we've identified two accounts that are involved. Are they increasing or decreasing? Let's look at the capital account. Is the capital account increasing? Yes. Then also the cash account for the business, is it increasing? Remember, he's removing money to put into the business. So is the cash received? Look at it from the company's perspective. Is the company receiving cash or is it giving out cash? Yes, it's receiving cash. So we also say the cash account is increasing. So the capital account and the cash account are both increasing. So now this is where I apply the double entry rules. Capital is a capital account. Okay. So if the capital account is increasing, you credit. All right. If the capital account is increasing, you credit. So credit the capital account 205,000. Cash is an asset. An increase in an asset, you debit. So you're going to debit the cash account 205,000. Right. So your journal entry will look like this. You debit cash and you credit capital. Debit cash, credit capital. Then after you do this journal entry, you're supposed to open the cash account and the capital account. Okay. So in the cash account, you have the debit balance of 205,000 and the capital account, you have the credit balance of 205,000. Yes. All right. 205,000. All right. Shouldn't be bank, should be capital here. Yes. Any questions before we move further? Yes. Can anybody help me with that? See if we've grasped the concept. Yes, you are audible. Oh, no, has it been? It's double entry rules. On capital, capital. Yes, yes. Mhm. Wonderful. Madam Natasha, is that okay? Okay. All right, so now we go to the second transaction, 2nd January. Put 90,000 of the cash into a bank account. So, first thing we identify what transaction is going on here. Mm-hmm. Mm-hmm. Yes, yes. The two accounts involved are cash and bank. So, which one is increasing and which one is decreasing? Or for those who are comfortable, which one is receiving, which one is giving? Yes, yes. So the bank account is increasing and the cash account is reducing. So this is now where we come to the double entry rules. Both accounts are asset accounts. All right. So bank is an asset, it's increasing, it's receiving. So we debit bank 90,000. Cash is an asset, it is reducing, we credit cash 90,000. Any questions? Okay. Transaction number 3. Bought goods for cash 105,000. Anybody to give us a preview of what transaction this is? Then you can also tell us the accounts involved, and then you can give an attempt on which one is increasing, which one is decreasing, and which one we can debit. All right. Yes. Anybody? Number 3. Bought goods for cash 100,500. Wonderful. 100,000. All right. You are very correct, Mr. Tapiwa. I just wanted to adjust your last statement. So purchases is an expense. Colleagues, remember this rule. Whenever you incur an expense, you debit the expense. All right. Whenever you incur an expense, you debit the expense. So the two accounts involved, purchases and cash. Purchases is an expense account. All right. Do not be tempted to say the inventory account and the cash account, right? Because the inventory account is dealt with differently. All right. It is dealt with differently. So you are not going to see an inventory account in in any of these transactions, even in the trial balance, you won't see any inventory account, right? It's dealt with differently. So yes, you debit the purchases expense, 105,000, and you credit cash. Cash is an asset, reduction in an asset you credit. Yes. And then you also open these two accounts, okay? Because as you are doing this journal entry, mhm. Yes, I can hear you. Mm, two different things, yes. You want the inventory account. Once you learn about it in inventory valuation. All right. You see how that's the topic shows how the inventory, how you get opening inventory, closing inventory. All right. It's dealt with in inventory valuation. So here, every time this business is buying goods for resale, you always be debiting the purchases account. Purchases is an expense. Yes. So your journal entries, you can put them in this format, all right, in one single table like this, right? Because these are going to guide you where to put in each ledger. So on the purchases ledger, on the purchases account, on the debit side, you put 100,500. On the cash account or the cash ledger, you put on the credit side 100,500. Bought goods on credit from Dhaka 8,000, Hambe 9,300, Sombaile 16,000, Lombe 5,100. Mm-hmm. Mm-hmm. Yes, you're correct. Yes. All these. Mm-hmm. Mm-hmm. That's correct. Yes, yes, yes. All right. So according to the accruals concept of accounting, all right, even though money hasn't been exchanged, you have to record transactions. Okay. So Dhaka, Hambe, Sombaile, and Lombe are now our payables. We're now owing them money. All right. So if you want, you can open individual accounts for these people. Right. Each of them will have credit balances. All right. In this case, because I saw there were more transactions involving some of these guys separately. So here in this case, you just have to open each of theirs. So yes, if you understand control accounts well, then you can open control accounts for receivables and payables. Then you also have the other transactions which involve these people. You have to know how to deal with them in there. So now, since most of us, it's when we're starting accounts and everything, so for understanding purposes, we'll open each of them. Most of them are going to open their accounts. All right. Daka, Hambe, Sombaile, Lombe. All right. Then with each transaction, you're always debiting purchases. So you debit purchases, then you credit Daka. You debit purchases, you credit Hambe. You debit purchases, you credit Sombaile. You debit purchases and you credit Lombe. Okay. Transaction number 5, bought stationery on credit from Banda 890 kwacha. So for me, I've already done the journal entries here. Okay, I hope, excuse me, I hope we're also recording them, recording these journal entries. So bought stationery on credit from Band 890. This is another credit purchase. All right. So you can debit stationery expense, right? And you credit Band 890. If you want, you can just debit purchases and credit to Band 890. But for clarity's sake, we'll just say stationary expense. So we'll debit stationary expense 890 and we'll credit Banda 890. Remember, Banda is a liability according to the double entry rules, which are here. All right, increase in a liability, you credit. Okay. Transaction 6. Sold goods on credit to R. Tonga, L. It's funny name. L. Fashanu 24, M. Silla 326, M. Sonda 2004. Yes, what transaction is this? What is happening here? Yes, 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 yes. Yes. Mhm. The other account which is involved is sales, the sales account. Sales is going to increase. Sales is a revenue account. Okay, sales. is a revenue account. An increase in revenue, right? You credit. So with each of these people, you'll be crediting sales. Okay. You debit R Tonga 17, you credit sales 17. You debit L Fashion 24, you credit sales 24. The- Yes. Our receivables, each receivable. Yes. Now remember, receivables are an asset to you. So an increase in your receivables, you debit. Paid rent by check 2,200. Oh, I forgot to show these journal entries here. For these people here, here are the journal entries which I already did. Okay, you see all of them, you'll be crediting sales, 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 then the receivables, each of them you debit. Yes, paid rent by check 2,200. Yes, paid rent by check. Yes, you are right on the two accounts that are involved, the rent expense and bank. But remember, it is us who are paying out that money from our bank account. So what happens to our bank account when we pay out money? It reduces, right? So you debit rent expense 2,200 and you credit bank 2,200. Bank is an asset account. Reduction in an asset, you credit. Rent is an expense. Whenever you incur an expense, you debit. All right. January 10th, bought fixtures on credit from Shefu Limited. Yes, anybody to give it to. That's true. Yes. Uh, payables, Chef Limited payables and their liability. Mm-hmm. Yes, it's an yeah, fixtures. It's an asset account. So since I no, you write fixtures, account fixtures. No, you just write it as fixtures, but you will know yourself that this is an asset account. Yes. So then you debit it since is we have acquired a new asset. So you debit fixtures. Then Chef Limited, their liability. We've acquired a new liability, increasing a liability, you credit. So colleagues, our advice at least you print out this table whenever you're studying accounts. All right. You can refer to this table. Yes, so you debit fixtures, credit Chef Limited 6,100. Paid salaries in cash 7,900. Yes. Mm-hmm. Yes. Salaries is an expense. When you incur an expense, you debit. Cash is an asset. When you're paying out cash, that's a reduction in an asset. Reduction in an asset, you credit. So 7,000. So you debit salaries 7,900, credit cash 7,900. Okay. We go to the next one. Returned goods to Hambe 300 and Emson Baile 420. Anyone doing bachelors of accounting and finance? These are the things you should participate in this. At least those doing business admin, human resource, you'll soon forget about this stuff. But it's important. Mm-hmm. 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 On that part. Okay, let me just interject. You are correct on everything, but we're not dealing with the purchases account this time. We're dealing with return outwards. Okay. Return outwards whenever you return goods back to your supplier. Yes. So return outwards is a contra expense account. Contra expense meaning it reduces the purchase expense. Okay. Remember in your trading account, you've got opening inventory purchases. Then you see a part where it says deduct return outwards. All right. So it's a contra expense. It reduces an expense. Mhm. 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 Return outwards accounts. Yes. Yes. You open that account. So since it's a contra expense account, return outwards. Whenever you hear the word contra, meaning the rules for it are opposite to an expense account. Remember an expense when you incur it, you debit. Now a contra expense, what's going to happen is you have to credit. All right, you have to. So you credit return outwards. Then since you return goods back to people who you're owing money, it means the Congole is going down, right? How much you're owing them is going down. So you are owing Hambe 9,300. You return goods worth 300. So you're now owing him 9,000. So remember, a reduction in a liability, you debit. All right. So you're going to debit Hambe 300. Then you credit return outwards 300. Then M Sombaile, you're going to debit 420. Then you're going to credit return outwards 420. Are we okay with that, colleagues? Number 15, bought van by check 160,500. Hello? Yeah, hello. Okay, yes, bought van by check 160,500. Mm-hmm. Mm-hmm. Mm. No, you won't credit the motor. You've you've you have, yes. Yes. So yes, two accounts involved, van account and bank account. Both are asset accounts. You've acquired a new asset, which is a van, increase in an asset, you debit. So you debit the van account, 160,500. Is that a question? T and M and M? You have a question? Mm. Yes, it is an expense. But please do not debit the purchases. Yeah, so you have acquired a van, which is an asset, increase in an asset, you debit the van account. You used money from the bank, all right? So money in the bank is an asset, reduction in an asset, you credit. So you credit bank 160,500 and you credit motor vehicle account 160,500. No, 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 no. We're not looking at it like that. We have acquired an asset, which is a van, and we used money to acquire that asset. So the two accounts here that will be involved are the asset, the van account, and the cash account. It won't be treated as an expense like those expenses in the profit or loss account. No. The way we're looking at it is we got a new asset and we paid for this asset by check. But you won't see this 1,006,500 in the statement of profit or loss. Right? That expense, think of it as an outflow of money. That's what involved the cash account. I mean the bank account. It's an outflow of money. We can go to the next one. Received a loan from Zanaco through bank transfer of 20,000. Which two accounts are involved? Which two bank accounts are involved? I mean, which two banks are involved? Mm-hmm. 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 Yeah. Yes, you debit you credit Zanaco. Yes, you credit Zanaco. I think I finished it. Which one? What are we crediting? So, yes, Zanaco and our bank account. Mhm. That loan account. Uh-huh. You credit Zanaco 20,000. Don't use loan. Mm, mm, 20,000. Mm. Other way around how? We debit Zanaco and credit our bank. That uh that yes. So madam, just follow the double entry rules, all right? We have a liability here, all right? Increase in a liability, you credit Zanaco 20,000, right? Use increase and decrease instead of receive and give. It will make life easier, all right? Because if you try to incorporate the two, there will be some transactions where you will now get confused. So our advice use increase and decrease, all right? It will make life easy for you. But if you're comfortable with give and receive, wonderful. Yeah. So we'll debit our bank account 20,000. We've received money increase in our asset 20,000. Then credit Zanaco. We've acquired a new payable or a new liability. All right. So you credit Zanaco 20,000. Goods were returned to us by R. Tonga 500 and M. Sila 710. Mhm. Return inwards, yes, or sales returns. Mhm. Very correct. Then, mhm. MC. Mhm. Yes. So here we're dealing with return inwards. Return inwards when people bring goods back to you. Return inwards is a contra revenue account. Remember, when you start your trading account, you start sales revenue, then you say let's return inwards. Right? Return inwards contra revenue because it reduces your revenue. Right? So here, these people, these are our receivables, all right? So they return goods to us. So what it's meaning is how much they're owing us reduces, all right? And they're our assets. So since our hmm? Okay, he was correct. I was just explaining further, justifying his answer. So I was saying that we're dealing with return inwards. Is a contra revenue account, meaning it reduces revenue. All right. So remember, revenue accounts increase with credit. So contra revenue account will increase with what? Debit. So you'll be debiting return inwards. All right. Then our Tonga and MCLA, they are our receivables. They are our assets. Now, since they've returned goods back, it means how the money they're owing us has reduced. Reduction in a receivable. All right. So receivable is an asset. A reduction in an asset, you credit. So you debit return inwards and you credit R Tonga 500. Then also you debit return inwards 710 and you credit R Tonga. Not R Tonga. You debit return inwards 710, then you credit MCLR 710. Okay. Cash sales 74,500. That's very correct, sir. Both are increased. Yes. Yes. Sales revenue, credit sales revenue, 74.5. Okay. So let me just explain on these ones because I've got class with the second years. So here, sold goods on credit. Remember, this is a credit sale. So you credit sales and you debit each of these people. These are your receivables. All right. Then for this one, where you paid the following by check, since you're going to credit bank account, all right. Then these are your payables. So you debit the reduction in payables, reduction in liability, you debit. All right. Received checks from R Plate and L Fashion. So these guys are our receivables. They are paying us. All right. So yeah, the true accounts to be involved will be bank accounts, they're paying by bank, and the receivables account. Since we are receiving money, the bank is an asset, so you debit bank. All right. Then these receivables you're going to credit them. Reduction in an asset, you credit. Received a further loan from Zanaco by cash 50,000. This time now the loan was given to you in cash, so you debit cash 50,000, then you credit Zanaco 50,000. And then the final one, received 6,014 cash from Musonda. You're receiving money from a receivable, so you debit cash and you credit Musonda. Whenever a receivable pays you, that's like a reduction in your asset. Reduction in an asset, you credit. So you're receiving cash, that's an increase in an asset. An increase in an asset, you debit. So when we meet next time,